This presentation examines revenue, costs, and profits for firms producing and selling products and services to consumers. At its simplest, revenue is the money coming into a business firm. The formula is sales times price. The sales and price are a direct result of consumer demand and producer supply. Consumers are willing and able to purchase certain amounts at certain prices, and producers are willing and able to bring to market certain amounts at certain prices. The interplay of supply and demand will determine the market price and ultimately sales as well. Now let's examine costs. Costs are a little more complicated. A firm costs can be broken down into two categories: fixed costs and variable costs. Fixed costs are those costs which are the same no matter how much or how little the firm chooses to produce at any given time. These costs are typically expenses for buildings and equipment that might have to be purchased or leased. Once purchased or leased, these items always impose the same costs on the firm regardless of how much or how little they are used. Variable costs, on the other hand, always increase as production increases. This would typically include things like labor and raw materials. The more you produce, the more labor and raw materials you will need to purchase from your workers and suppliers. When you add fixed costs and variable costs, you get total costs. Thus, fixed costs plus variable costs equal total costs. Firms are not so concerned with total costs, but with average costs. Average costs reflect how much each unit on average costs to produce. Average total cost is computed by dividing total cost by output. Similarly, average variable costs are computed by dividing variable costs by output. Though it is not shown in the graph above, you can also compute average fixed costs, which will continually decline as output increases. Since total costs equal fixed costs plus variable costs, then fixed costs equal total cost minus variable costs, and average fixed costs equal average total cost minus average variable cost. Thus, though it's not labeled, the average fixed cost is represented in the graph above by the distance between the ATC curve and the AVC curve. Firms are also concerned with how much each unit produced is adding to total costs. This additional or marginal cost typically rises as production increases, though it may fall at first. The additional cost is always a positive number, of course, since producing more product always increases costs in absolute terms. But if producing an additional unit adds less to cost than the previous unit produced added to cost, then marginal cost would fall. This is the case at first in the graph above. Marginal costs, or MC, does turn upward, though, eventually. The MC tends to increase for two reasons. One, as firms increase their demand for resources, land, labor, capital, and entrepreneurial talent, they drive up the price of those resources just as the laws of supply and demand would predict. And two, beyond a certain point, you run into what economists refer to as the law of diminishing marginal returns. For example, if you add 1 ounce of fertilizer to a flower pot full of tomato plants, you might see 10 additional tomatoes produced. Adding a second ounce, however, might only produce another 8 tomatoes, or in a third ounce, maybe an additional 3 tomatoes. You will not get the same bang for your buck from the last ounce you add as you got from the first. This is also true for things like studying or working out. The first hour spent studying or working out may produce substantial results in terms of higher grades or greater strength or performance. But after a while, additional hours spent studying or working out produce very little return. Thus, marginal cost per unit of return tend to rise. Finally, you will note in the diagram that marginal cost cuts the average total cost and average variable cost curves at the minimum or lowest point. This makes sense when you think about it. If the additional cost is below the average, it will pull the average down, and if the additional or marginal cost is above the average, it will pull the average up. Thus, it is the MC curve that bends the average cost curve down and then turns it up again. Here is the information presented in table form. You will note how fixed costs are the same at all levels of output, and that average fixed costs decline as you divide that same number, 100, by larger outputs. Note also that total costs increase by the amount of the variable costs, and that marginal costs equal the difference in total cost from the one output to the next. Finally, you also note that the point where MC exceeds ATC is where ATC stops falling and begins to rise. The significance of this point will be discussed in the next slide. The flexion point, or lowest point of the ATC curve, is the point of maximum productive efficiency. It is at the output level Q in the graph here that the firm is producing at the lowest per unit cost possible. This is referred to as economies of scale. Beyond Q, however, the firm is experiencing diseconomies of scale as average costs per unit begin to rise as production increases. Firms will generally try to minimize their per unit costs, but there may be circumstances in which they operate inefficiently. We'll examine that phenomenon in a later presentation. The difference between total revenue and total cost is the profit. Thus, in its simplest form, TR minus TC is equal to profit. An accountant will view profit differently than will an economist. When computing profit, an accountant only looks at the raw numbers of money coming in, revenue, and money going out, costs. They do not generally take into account the opportunity cost for the entrepreneur or investor. The entrepreneur, just like anyone else, must be paid. They must be paid both for their labor and for the risk they assume in starting the enterprise. They also must be compensated for the time they must spend waiting for their profit to come in. Building a factory, for example, takes a great deal of time. During the building process, resources must be paid for. Even after production starts, the goods still have to be marketed and sold before any revenue comes in. The investor or entrepreneur could have been collecting interest on those funds that were expended in the expectation of future profit. Profits must at least equal that alternative return on investment, or the business is not really profitable. If my profit is less than I could have earned elsewhere, I'll take my investment elsewhere. Ultimately, I'm not just seeking a profit, but the largest profit possible. Investment in talent will generally flow to where it will be best paid, and thus a more accurate formula for profit would be total revenue minus accounting costs minus opportunity costs is equal to economic profit. There are 5 major purposes for profit. They are 1. To provide an incentive for future investment. 2. To signal to entrepreneurs what people actually want. 3. To provide a means for directing scarce resources into the production of those goods people actually want. 4. To reward successful risk-taking. And 5. To spur competition. Profits are crucial to economic prosperity. Higher profits indicate that a firm is meeting the needs of consumers in the most efficient manner possible. Losses, on the other hand, indicate inefficiency and the waste of economic resources. This is why government subsidies or bailouts to losing firms are so wasteful and inefficient. The subsidies or bailouts keep inefficient losers in business, and they thus allow these firms to continue to waste resources that could be put to better use by more efficient competing firms. Worse, the successful, efficient firms and the people are penalized for their success by being taxed to pay for the subsidies to the least efficient.